In corporate finance, many different names are thrown around for what is essentially the same thing, debt. But clearly each name connotes a different flavor of debt. You may sometimes be looking at the plain vanilla, or at other times something a bit more exotic and nuanced. So what is debt? The answer to this question may seem obvious since the balance sheet for a firm shows the outstanding liabilities of a firm. This is what I shall be discussing today. There are items of the balance sheet that create fixed commitments for the firm and provide the same tax deductions that interest payments on debt do. The most prominent of these off-balance sheet items are operating leases. Consider what an operating lease involves. A retail firm leases a store space for 12 years and enters into a lease agreement with the owner of the space, agreeing to pay a fixed amount each year for that period. I do not see much difference between this commitment and borrowing money from a bank and agreeing to pay off the bank loan over 12 years in equal annual installments. For all intents and purposes, therefore, operating leases are debt. Converting operating lease expenses into a debt equivalent is straightforward. The operating lease commitments in future years should be discounted back at a rate that reflects their status as unsecured and risky debt. As an approximation, using the firm's current pre-tax cost of borrowing as the discount rate yields a good estimate of the value of operating leases. Another form of off-balance sheet financing is the special purpose vehicle or entity, that is SPV or SPE. An SPV or SPE is a company that is created especially for the purpose of financing another. The idea is to protect the capital structure of the company being financed by not putting the debt and/or equity on its balance sheet. SPVs are especially useful for parties that are capital deficient to be able to undertake large-scale acquisitions or buy-ins. The next form of debt to consider is the bond. Bonds are a form of medium and long-term securities. Bonds may be issued on a fixed rate basis or a floating rate. Bonds mean borrowing from the capital markets and dealing directly without the intervention of a bank. A bond is a form of security, which means that it is transferable. A firm can issue a bond either in its home country or a foreign bond in another country. For instance, a Yankee bond in the US or a samurai bond in Japan, or an international bond like the Eurobond. Foreign or international bonds enable corporations in especially smaller countries to be able to raise large amounts of debt that they can't raise in their own home countries. Some key features of a bond include a trust deed, a trustee institution, interest, ranking in terms of the company's other debt, repayment provisions, and so on. Bonds and other loans frequently also have debt covenants. These are provisions that lenders require to be included in the terms of the debt that require the borrower to maintain the company's affairs, especially financial, in a particular state. For example, there may be a requirement that the company maintain a set of financial ratios at certain levels or ranges. The purpose of debt covenants is to protect the lenders as much as possible against the possibility of default or negligence on the part of management. Some bonds are convertible. Unlike the common or garden bond, a convertible bond can change its spots. A convertible security may start life as a debt or hybrid instrument, but later be converted into common stock. You can think of a convertible bond as equivalent to a normal bond plus a call option to acquire common stock in the company. Bonds can be valued as the present value of the regular interest payments and the final principal payments, discounted at a rate that reflects the risk of default. The level of the interest payments is fixed on issue, and therefore an investor is buying the right to receive a set of regular coupon or interest payments together with the final return of the principal. The next form of debt to consider are asset-backed securities. Instead of borrowing money directly, companies sometimes bundle up a group of assets and then sell the cash flows from these assets. One class of asset-backed securities, mortgage-backed securities, or MBS for short, were principally responsible for the great financial crisis of 2008. Without getting into the complicated financial intricacies, a good way to understand what happened is ably depicted in an entertaining way in the movie The Big Short, starring an all-star cast. During COVID-19 induced disruptions to financial markets, the Fed's Federal Open Market Committee intervened heavily to ensure a smooth functioning of the secondary MBS market. Of course, not all debt is issued publicly. Many companies raise debt through private placements with a few institutions. This debt, however, would most likely carry similar terms and conditions as publicly issued debt, except that there may be flexibility to renegotiate matters as corporate or market conditions change. Project finance, on the other hand, is non-recourse financing. It involves the creation of a separate entity for a project that can stand apart from the business of the sponsor. The brief could be to design, construct, and operate, for example, a power station for a utility. Generally, the future cash flows can be forecast and used as security for the project financing. The objectives are to establish a vehicle to receive capital in the form of equity and debt, expend the funds on constructing assets, generate a revenue stream to pay back the loans, and provide an acceptable return to the equity participants and demonstrate the security in the project to the lenders. The difference between project finance and a traditional loan is that the former depends on the ability of the project to generate sufficient funds for loan repayment. In a traditional loan, the borrower is responsible for repayment, whereas the project vehicle is ring-fenced from other assets of the sponsor. Financial engineering and structuring seek to allocate the potential gains and losses between the parties. Funders need to carefully examine the sources of risk, since there is no diversification of risk, as there would be when a company undertakes a range of projects. In addition, projects are typically sizable and perhaps too large for one participant to accept all the risk. While a company seeking a loan can show the lenders an operating history and annual reports, a project plan can only point to future profitability and cash flows. Project financing arrangements usually include mutual interests in structuring over and above separate financing for allocating risk and reward. That's it for today's video. I hope you found this analysis insightful. If you did, please like this video and don't forget to subscribe to our channel for more engaging content like this. As always, I appreciate your support.